Hey everybody, how are you doing? Welcome to another edition of the Biotech Tape Check with Hartaj Singh here with the Biotech Capital Compass. It is one of those very hot days here in New York City and I'm dialing in from Brooklyn. It is hot wherever you are, so try to stay cool and hydrated. I think it's very important. And some of you sharp-eyed folks can probably tell that I've been out and about in the sun recently because of the slight turban tan peeking out of my forehead. This is a true Sikh delight, and it only gets better over the summer. Once you dial into future biotech tape checks, you might actually get a peek, underneath to see some of what I'm talking about. I don't want to get in trouble with any of my Sikh readers or listeners here. So, why this Monday morning biotech tape check? Over the last week, several headlines caught my attention. Individually, none was particularly surprising. Together, however, they began creating a narrative that felt more negative than the underlying fundamentals might justify. A Seeking Alpha article noted that biotech stocks may be losing momentum despite strong M&A activity. We saw reports of nearly 7,000 biotechnology and pharmaceutical employees affected by layoffs. We saw Summit Therapeutics announce and then withdraw a planned $500 million secondary offering. We continue to see discussions among biotech companies about cash runways, financing challenges, and the pace of the sector's recovery. So as a former sell-side analyst and buy-side investor, these are the moments when I like to pause and take inventory. Not because the headlines are wrong, but because headlines often tell us what happened. They do not always tell us what that means. So today I want to discuss two questions. What is the biotechnology job market actually telling us? And what does Summit's pulled financing really say about capital formation in biotech? I've got a little bit of a hoarse throat, so bear with me. I need some warm liquids and a little bit of coffee, kind of keep me going. This is a Friday, TGIF. Let's start with the job market. The headline was certainly attention-grabbing. According to Biospace, approximately 6,956 employees were affected by or made redundant or they were projected to be laid off in May 2026. If you look at the first chart below in the newsletter, May stands out dramatically, especially on a year-on-year basis, and even from previous months sequentially, February, March, or April. So at first glance, this appears concerning, but let's look one level deeper. The majority of those layoffs came from two companies, Takeda and Biotech. Together, they accounted for more than 6,300 positions out of those 6,900 plus. That distinction matters because what we're seeing is not necessarily a broad collapse in biotechnology employment. Instead, much of the activity appears tied to large company restructuring, operational streamlining, and resource allocation. Takeda continues to optimize its operating structure. Biotech continues to transition from a COVID-era infrastructure footprint towards a more oncology-focused future. These are difficult decisions for affected employees, but they're not necessarily evidence that biotechnology innovation is slowing. In fact, some of the conversations I've had recently suggest the opposite. Hiring continues, just selectively. One executive recruiter quoted by Biospace described companies increasingly looking for plug-and-play talent, individuals who can contribute immediately and fill highly specific strategic needs. That observation resonates with what I continue to hear from management teams, recruiters, and investors. The labor market is not frozen. The labor market is discriminating. Capital and companies are hiring carefully. And frankly, after several years of excesses, followed by severe funding correction, that should not surprise anyone. The second chart is also interesting. This chart comes from a LinkedIn poll with more than 500 participants and provides a useful snapshot of current industry sentiment. Most respondents do not expect an immediate recovery. And again, this chart is embedded in the newsletter down at the bottom. If you read it, and this is the chart where the question is asked, when do you think the biopharma job market will turn around? And again, it was a LinkedIn poll with more than 500 respondents, and I thank Biospace for this. Also, they're the ones that presented this in the article that I read. Now, most respondents do not expect an immediate recovery, but they do not appear to expect a prolonged collapse. The majority see improvement occurring between late 2026 and 2029, to me, that reflects cautious optimism, not enthusiasm, not pessimism, caution. And caution is probably an appropriate mindset for this stage of the cycle. Now, if I can just pause here also, and let's just take a look at this chart. I'll put my analyst, quote unquote, turban on. So if you look at it, and the question is, when do you think biopharma job market will turn around? The answers are by the end of 2026, 2027, and so forth and so on. What you see is the clustering is roughly in the mid-20s, 23% for the end of 2026, 27% for the end of 2027, and again in the 20s, 2028 and 2029. That tells me that actually people are not sure. So think about it. If you have a two-sided coin, you flip it enough times, statistics will tell you'll get a 50-50 distribution. So here, respondents were given 4 answers. And essentially, their responses boil down to a coin flip for each one of those 4. So that tells me that respondents, even though it looks like our job market is difficult, are still not sure, if we're to recover by the end of 2026 or 2027 or as late as 2029 or later. That could be bad. This distribution does look like it could be bad, but that also tells me to the flip side of that, which is that, people are unsure. Actually, the recovery could happen a lot more quickly than what people are expecting, because essentially the answer here amounts to, figuratively, I would actually call it almost like a coin flip, because they were given 4 responses and, the answers boil down to a quarter each roughly. So let's move on. Let's turn to Summit Therapeutics. This story generated considerable discussion. The company announced a $500 million secondary offering, then withdrew it one day later. The immediate reaction in some corners of the market was concern. Was this a sign that financing conditions are deteriorating? I'm not convinced. Let's consider the context. Summit stock had an extraordinary run in April. Investor expectations surrounding ivonescimab became exceptionally high. Then came ASCO. As abstracts emerged and full data were presented, investor discussions became more nuanced. The debate shifted from whether ivonescimab was a promising drug to how promising it might ultimately prove to be relative to already elevated expectations. That distinction matters. So again, let me say that again. The debate shifted from whether ivonescimab was a promising drug to how promising it might ultimately prove to be relative to already elevated expectations. Some of you might be shaking your head and saying, what did he just say? Think of it this way. Imagine that you were expecting a bonus of 100 at the end of the year, but you got 60. Now, some might say, wow, just getting a bonus is good. Some might say a bonus of 60 is really, really good. But if you were expecting a bonus of 100, then you were definitely going to be disappointed, right? Similar thing probably happened with the ivonescimab data at ASCO. This is just speculation on my part. So, this distinction matters. The stock subsequently declined significantly from its April highs. Against that backdrop, Summit attempted to raise capital, then chose not to proceed. Importantly, the company still possesses a substantial cash position. This does not appear to be a company facing an immediate liquidity crisis. Rather, management may simply have decided that raising capital at a significantly lower valuation than what was available a few months earlier was not in the shareholders' best interest. In other words, the financing window may have remained open. The valuation window may not have been. Very important distinction again. The financing window may have remained open, meaning capital was available, but the valuation window may not have been. What investor sentiment was saying towards the stock of Summit and what the management and the board and current shareholders of Summit were willing to accept for another capital raise. So those are 2 very different conclusions. Stepping back, I think both stories ultimately point towards the same broader theme. Biotechnology recovery remains real, but it remains uneven. Capital is available, but not for everyone. Hiring is occurring, but not everywhere, and not for everyone. Investors remain interested, but they're increasingly selective. In fact, one of the more interesting developments over the last year is that biotech increasingly appears to have a capital concentration problem rather than a capital availability problem. Capital is flowing, but is flowing disproportionately towards the companies, management teams, and assets that investors believe have already crossed an important threshold of validation. That can be frustrating for companies still trying to prove themselves. But it is very different from saying capital has disappeared. That selectivity can sometimes feel uncomfortable because it creates a widening gap between winners and losers. Yet historically, these windows of differentiation have often laid the foundation for the next phase of the cycle. Companies with strong balance sheets, compelling clinical data, disciplined capital allocation, and clear strategic focus tend to emerge stronger. The companies that do not often struggle, these are companies that don't often struggle, that process is rarely present, but it is usually healthy. So, as we move through the remainder of 2026, and by the way, we're only 2 weeks away from the middle of 2026. I can't believe how quickly this year is going by. I suspect investors should continue focusing less on individual headlines and more on the broader pattern. Because while layoffs, financing, and stock price movements often dominate the news cycle, the deeper questions remain unchanged. Is innovation continuing? Is capital formation improving? Are patients gaining access to better therapies? And are companies creating durable value? The recovery remains uneven. The headlines remain noisy. And when I step back and look at the broader ecosystem, I continue to see more evidence of rebuilding than deterioration. Thank you for joining me. I'm Hartaj Singh. Have a wonderful week. Stay cool, stay hydrated. And as always, thank you for reading and supporting the Biotech Capital Compass. Take care, everybody.